In this video, we're going to be performing a deep dive on Verizon's dividend safety. To begin, let's talk about Verizon's business model. Verizon was created by a merger between Bell Atlantic Corporation and GTE Corporation in June of 2000. The company is the largest wireless telephone carrier in the country. Verizon also offers broadband and cable services. The company's network covers approximately 300 million people and 98% of the United States. Verizon trades on the New York Stock Exchange with a market capitalization of $229 billion. Verizon is a well-known blue-chip stock because of its low risk and high dividend yield. In fact, Verizon is one of few publicly traded companies that has a yield above 4%. This makes the company attractive for retirees and other income-oriented investors. Looking ahead, Verizon's high dividend yield has led many investors to question the safety of its future dividend payments. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives: its current dividend safety in the context of current earnings, its dividend safety in the context of current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Verizon's dividend safety in the context of the company's current earnings. When Verizon reported financial results for the second quarter of fiscal 2018 on July 24th, the company updated its full-year financial guidance. It now expects low single-digit percentage growth in adjusted EPS in 2018. Applying a 3% growth rate to Verizon's 2017 adjusted earnings per share figure of $3.74 allows us to compute a 2018 estimate of $3.85. For context, Verizon currently pays a quarterly dividend of 60.25 cents per share, which implies a payout ratio of 62.6% using our 2018 earnings estimate. Using earnings, Verizon's dividend is very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Verizon's current dividend payment to its free cash flow. Through the first 6 months of fiscal 2018, Verizon generated $16.4 billion of operating cash flow and spent $7.8 billion on capital expenditures. This implies free cash flow of $8.6 billion for the first half of the year. During the same time period, Verizon spent $4.8 billion on common share dividends. This implies a free cash flow dividend payout ratio of 55.8%. Using free cash flow, our conclusion is the same. Verizon's dividend is very safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Verizon's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Verizon's performance during this time period is shown here. As you can see, Verizon's earnings per share were minimally affected by the financial crisis. Accordingly, we have no concerns about the company's ability to pay rising dividends through future economic downturns. The last angle that we will use to assess Verizon's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before Verizon's free cash flow will no longer cover its dividend payment. At the end of the most recent reporting period, Verizon had $114.6 billion of debt outstanding. The company generated $2.423 billion of interest expense during the first 6 months of the fiscal year, which implies a weighted average interest rate of 4.2%. The following image shows how changes to Verizon's weighted average interest rate would impact the company's dividend coverage, as measured by free cash flow. As the image shows, Verizon's weighted average interest rate would need to rise above the 10% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Verizon's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Verizon's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you are interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.